TheoTrade. This is Don Kaufman. January 27th, 2021. Risk in the marketplace just absolutely explodes in a wave of sell-side activity. Pretty much across the board, the S&Ps are down about 3%. The Nasdaq down about 3%. The Russell, actually the stronger suitor on the trading session. We're about an hour and a half after the cash close. We wanted to wait for some of the earnings to come out from Facebook, Tesla, Apple. Let's get to work and actually explore a little bit of some of today's sell-side activity. One of the first things that I want to bring into scope that I think is critical coming into the remainder of this trading week, let's cruise over to the SPX. Now, for those of you aware, maybe unaware, we look just continuously at SPX and the expected move. Now, in this week of trade, now this is for the entire week of trade, we were looking for plus or minus approximately $77 move, right? So that means you're looking for this market to move up $77 or down $77. Today, clearly, very decisively, we actually broke through that. So does it mean it's all over for the marketplace? Not at all. And this is what I want to kind of clarify because there are some very key levels in play. Let's go all the way down into some intraday trade. Right out of the gate this morning, sell-side activity really smashed the marketplace. I mean, this is a quick and vicious drop. That drop literally took us right to, and this is the lower edge of the expected move. Now, to really kind of zero in on a level, the lower edge of the expected move happens to be 37.67, right there on the button. And what I want to display is the marketplace literally stopped on a dime. We rallied off of it, came back off, reverberated back up, okay, came back to it, and ultimately we broke lower. Now, the fact that we closed in and around this 37.50, we're still holding, again, we're holding on to that kind of lower rung of the expected move. And I cannot stress enough how pivotal that level happens to be as we move on to Thursday and Friday of trade. If we start to really lose, okay, that 37.50 level, okay, that's where sell-side activity absolutely could expand out. And then you have to start thinking about, okay, instead of plus or minus $77, then you have to look at ultimately what we kind of call 2 sigma moves. So here we are looking for the $77 move higher or $77 move lower. All of a sudden, when you start to crack through the edge of an expected move, we can accelerate. And that sell-side activity, you know, before you know it, now you have a $150+ move on your hands. And you can see that the S&Ps, they did some more damage in the after-hours trade today. So again, even though I mentioned, and I want to really clarify this, even though I mentioned this kind of 37.67 level, just as long as we're hanging out here at like 37.50, we're still okay. Listen, that's 17 points. It's a hop, skip, and a jump away. But once you start to lose like the 37.50 level, the marketplace, as I said, can really accelerate because what drives trade is hedging, okay, is gamma risk. And the moment you start to lose this edge of the expected move, they're going to have to sell into selling. Now, one other aspect that is imperative to understand about the edge of the expected move, just the expected move in general, the entire trading week, people, the entire trading week, okay, at the start of this week, only had, as I said, about a $77 move. Behold, okay, we only have Thursday and Friday left. You're now looking at a $112 move on a 44% implied volatility. So when I started off, you know, tonight's video, I said risk explodes in a wave of selling. This is what I'm referencing in terms of risk exploding. Let's move on to the next key point in here. So obviously, keep your helmet on for the remainder of this week. It is going to be Mr. Toad's wild ride, right? For Thursday and Friday, $112 move. And that's why I say, okay, we're right on the cusp here. We're right on the cusp. We're going to have a full 2 deviation break. Then you can actually even look for like a 3 deviation break, you know, and that's when things can just get downright hideous inside of a marketplace. Next point to be taken here, number 2 on the docket, volatility. Again, it explodes. So most people look at the VIX. Me, not so much. But the VIX, up 61% today, right? And just tore to the upside as some of the earnings came out after. Again, after the close. What earnings came out? Well, obviously, Tesla started to really, influence the marketplace to a degree. Now, the moment that Tesla came out is where you see the spike in the VIX. That sell-side activity in Tesla has kind of been mitigated. Let me come back to this, all right, momentarily. And I will come back to this. But the VIX, again, took off to the upside. What to me matters even more is right here. The volatility futures. It's not about the spike in the volatility futures. It's about, did the volatility futures invert? And the answer to that is absolutely. Okay. What a difference one trading session can ultimately make. So I'm just going to highlight for a second the volatility futures and exactly what we are referencing in this particular case. And that happens to be the active contract, which is the February contract, spiked all the way to 33. Okay. Some of the back month contracts are left, 31.80, 30.84. So we are full-fledged now. The volatility futures have inverted. And what that basically means is that February volatility, which means the volatility here and now with only 21 days remaining, is higher than, for instance, 49 days out. Now, you have to, again, kind of interpolate what that amounts to. What is the marketplace really saying? The marketplace is really saying the risk in 21 days, in the next 21 days, is more prevalent. The risk is higher. So the world has a better chance of falling apart at the seams in the next 21 days than it does, for example, 84 days out. And that's one of the things that logically, people have to really wrap your head around that. As soon as the volatility futures invert, though, it changes everything in this business. It changes the way that market makers lay off risk. So all of a sudden, the S&P futures become incredibly, incredibly volatile at that point. By the way, you can see them kind of resetting the futures here as we come back to the futures are going to open again. They're going to open in just about 20 minutes. All right, so the volatility futures have inverted. The next thing I want to bring up, bonds. Bonds didn't exactly have much influence. So the Fed came out today, and you would expect, oh, right, the Fed came out, yada, yada, yada. We didn't explode to the upside, and the volume picked up a little bit, but this is something to watch very, very carefully in the days to come. Are the bonds going to explode? Well, the bonds didn't explode, but the dollar absolutely had a substantial move to the upside. So we want to look for more movement to the upside in bonds. That would be indicative of a lot of risk. More movement to the upside in the dollar. Why the dollar? Because in the end, if these marketplaces are really going to come apart, everybody's going to rush into the dollar. Because in the end, our currency is, well, better than their currency, right? And people go, oh, the dollar's going to get devalued. It's garbage. Yes, but our garbage is better than their garbage. Think about that for a second, because it is relative right now. Again, if these markets are going to get volatile in the days to come, look for big spikes up inside of the dollar. All right. With the fact that the bonds rallied a little bit, with the fact that the dollar really made a nice sized move, it was the financials. The financials have seen sell-side activity, and I've pointed this out incessantly, that the marketplace would eventually just crack and start to roll over if we continued to see some sell-side activity inside of the financials. This wasn't just, today. It was yesterday, It was days before that. You've had 2 weeks of sell-side activity inside of the financials. Eventually, it was going to start to cave in, the monsters of tech. But in a larger sense, I want to look back at the Nasdaq futures. And the reason I want to look back at the Nasdaq futures is, was some damage done today? According to the Nasdaq futures, look at the marketplace, you're like, oh man, it was down over 3%. It was hideous. What did we do? You got 1, 2, 3, 4, 5 trading days. The point that I want to make, at least at this point in time, is when people look at this, they're like, that was a big down day. Yeah, great. You've basically undone the last 4 or 5 days inside of the Nasdaq, which amounts to absolutely nothing. Don't tell me that this is sell-side activity. I don't even want to hear it. You could see the Nasdaq fall 1,000+ points inside of a single trading session. Somebody actually asked me, is this the time we should go out there and start to buy stocks again? People, ease up here for just a second. The S&Ps are still up dramatically on the year. We're not back to what? But a couple of prior trading sessions. In fact, when you start looking at the IWM, the IWM, what did it do? It's back to what we called Monday? I mean, really, these moves, although they were vicious and they were vicious one-day moves, net, they amount to absolutely nothing. And when you start looking at this in a broader context, and again, you got to at times have perspective. When you want to look at this in a broader context, okay, for the spiders to really start to do some damage, I mean, I really think you got to come back down to levels like what? 320 in the spiders. That's right, 3,200. Why? Come on, that's only getting back to where we were in November. You know, that the marketplace itself, it's again, been overheated for a substantial period of time. Now, was this the bubble that, heard round the world that just popped? Possibly. We'll know more, obviously, in the next 2 days of trade. The last thing I want to leave you with, and this is where risk is just huge and open-ended. Earnings came out tonight. So you had earnings of Apple. Start with Apple. Apple, okay, they're having their conference call literally right now. And again, in about 15 minutes, the futures are going to reopen. Apple's been all over the place tonight. And this is the warning to you, okay? Apple has almost an $11 expected move. You need to anticipate that every ounce of that $11 expected move, okay, could be achieved. In doing so, okay, you could crush the S&P futures. If Apple moves down $11, it's going to put pressure into the Nasdaq. It's going to put pressure into the S&Ps. Right now, Apple is off by what? $4 here? Okay. Oh, but still my heart. This is absolutely nothing is the point that I'm trying to make. Next on the docket, Facebook. Facebook is actually flat to kind of bid up, but this is intimidating. It has a $20 expected move. The ranges unto which we can move tomorrow, okay, through Friday, they're huge. You can't just look at this and say, well, we could move $20. Now, we're going to extend ourselves, and the markets are going to be rocking, all right? So the fact that it's only making this $2 move over here, that doesn't make me feel exactly warm and fuzzy. The point that I'm making is we could extend to the downside. All of a sudden, you get Facebook down $20. You get Apple down, $10, $11, okay? Lo and behold, here's the big one, okay? The big one is in sheer respect to the fact that Tesla, okay, has almost an $85 expected move, trading at 142 volatility. Now, Tesla has been all over the place, again, all over the place in the after hours trade here. And it did absolutely unequivocally influence the VIX. Like this big move down in Tesla, okay, corresponded to that big move up inside of the volatility index. So Tesla itself, okay, this is the preeminent underlying to watch inside of tomorrow's trade because the influence is simply massive back upon the S&P 500 with an $85 expected move. Elon Musk better be very careful what he says inside of this conference call. It's only down. Again, it's negligible at this point. What's another 20, another $30? But if it were to extend down a full 85, for instance, coming into tomorrow's cash open, we're in trouble. There is a lot to think about. There's a lot of risk on the table. The one thing I will stress to you, if you're long this marketplace, you better love the positions you're in right now. You better love your risk, okay? Because this is not a time, okay, to kind of goof around with positions. This is not a time to be looking, well, what about GameStop, okay? GameStop has become the poster child for what could, in fact, be the beginning of the bubble bursting. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.